Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry Lutz. And 2015, what is it going to bring us? That's the question. Is the commodity implosion going to continue? Are we going to see true deflation, or will they just keep printing their way out of it? Derivatives, where are they heading? And what do you do about it? Well, with us now is Bob Hoye of institutionaladvisors.com. He's pretty much called this thing great economic historian. Bob, should we invest in tulips or derivatives, or gold? What's our choice here?
Well,
and
I
Happy
guess
New Year.
Best you too. One would have to say that tulips would be a seasonal trade.
Well, it depends where, I guess, huh?
Yeah. I was talking with some of my buddies the other day and looked back, and, the gold bug, who knows that the exercise of the Federal Reserve is absolutely stupid and will continue. The gold bug has been active for 50 years now. Mm-hmm. Beginning in the 60s, Jim Dines and people like that. And there was a strong condemnation of central bank policies. And I can criticize the central bank as well, because they're dealing with not a full deck. They have this idea that if you push credit out, that prices will go up, and that'll stimulate business. And of course, the gold bugs took that idea as well, that prices would go up, but only gold would go up. So what you've had is that the Federal Reserve cannot be overly ambitious unless it has a speculator out there. And to borrow money, to get leverage. That's what they desperately need. So what you've had over the 50 years, you had eventually traditions. Beginning in the 60s, the Federal Reserve became very ambitious then with the idea that with enough money floating around, they could eliminate the business cycle. God, I remember that in 1965. And then the other part of that, they were trying to keep interest rates from going above 3%, and that was the 1940s, by buying bonds, i.e. an inflationary policy. And then in the 60s, not only were they going to eliminate the business cycle, but they were going to keep then rates from rising above 6%, and that was called Operation Twist, because it was had to do with the new dance craze that came out then. And they kept buying bonds out of the market to keep rates above 6%, while in U.S. long Treasury got up to 15% in 1981. But what was happening then is that all of the excess lolly was going into wage inflation, commodity inflation, CPI inflation, the whole thing. Now that blew out around 81, and Volcker gets the credit for that because he was head of the Fed when it changed. But all it was a blowout in commodities like 1920. So then what followed was, and here's a line I crafted in the first part of 1982, I guess it was that, and keep in mind that at that time, portfolio managers were all positioned for a bear market and for inflation and the commodities, the whole thing, you see. So the view we had then was that no matter how much the Fed print, and we thought it would continue to print, but that financial assets would outperform tangible assets. So then you change the party. So commodities crashed, and out of the first part of 1982, you started the financial bubbles, and you had a fabulous bull market for stocks. And keep in mind that the long Treasury rate was then 15%, and it's come all the way down into the twos here now. So what you've had is that the Fed, if you look at the money supply in 1980-81, it didn't change. It continued to grow. So Volcker did not tighten. Commodities blew out and crashed, and then the speculators then turned to other assets, which were financial assets, and these are where these bubbles keep coming and going. So then let's just bring it up to 2011, which was a key year when you completed a 10-year bull market in gold. It was also an important high for base metals as well, and we have a long-term guide we call the Momentum Peak Forecaster, and it doesn't work on every big high or every business cycle, but when it does, we have respect for it. So it got up and gave a big signal in 2011, and we took it as being marking the end of the speculation in whatever was hot then. Well, what was hot were base metals and precious metals. The other one that backed up becoming careful in the precious metals was that we follow the silver-gold ratio, and we do a momentum thing on it called the RSI. So in any bull market for silver and gold, silver will outperform gold, and the silver-gold ratio goes up. And then when it gets exciting, the RSI on that ratio will get up to the high 70s, and that becomes dangerous. I think it was June of 2011, it got up to 92. So we looked back, and the only time it had been that high was in January of 1980, which was the great, huge secular high for gold and silver. So our advice then was that that measure of speculation had become dangerous, and that you'd have a bear market, but it wouldn't be as bad as what followed 1980. But I'm telling you, bear markets are always bad.
Sure.
So then that started to correct the huge excesses, going up to 2011. Major mining companies were acquiring properties in geologically difficult places, in politically difficult places. It sort of became a compulsion.
Yeah.
So anyways, all of this is being corrected out in the bear market that followed. The secondary rally was out till September of 2012, and that is when, in that summer, the European Central Bank announced that they were going to be very aggressive. And then that's also then September when Bernanke announced that he was going to start the bond buying program. And the gold bug community took that as, this is really going to inflate and depreciate the dollar, and gold will go even higher. But that was in the market, and then the RSI on the silver-gold ratio, I think it was 84 on that one, which anything above 78 is dangerous, so we let our readers know that. And then the last time we got excitement was beginning in Christmas a year ago when, base metals and the grains, a number of commodity groups became very oversold, including the precious metals, and that's when we called it a big rotation, that you'd get a rally out of these things as they bottomed and then moved up into the spring of 2014. So, and that's what we did. We get good rallies. So May of last year, that RSI on the silver-gold ratio, it got up to, I think it was 82 on that one. Again, dangerous.
Mm-hmm.
So then that had to wash out. So what we're looking at now on repositioning in gold and silver, and we've been very careful on this, is that wanted the gold stocks to begin to outperform the bullion price. And that's been on for 5 or 6 weeks now, building a good base. But in the last week, it moved up to above the 50-day moving average, which is constructive. The other one we wanted was to have the gold-silver ratio, or silver-gold ratio starting to move up, with silver beginning to outperform gold. And that set a long base here of many weeks. And in the last let's say 7 or 8 trading days, it's moved up. So, and then the final one is that you've had this big opposite stuff going on where orthodox investments in stocks and low-grade bonds have done well. Low-grade bonds have not done well since June, but the long treasury has been doing very well. So what I wrote last week, and I've been talking to a guy who retired some time ago from managing a gold fund. He'd sold out long quite a bit ago. And I was telling him that, hey, the real price of gold is going up. These things are getting constructive. And he said, good. Gold to 5,000? I said, no. But what you've had, Kerry, is that the stock market is at the equivalent of 5,000 gold.
Yeah.
Okay. Now then, junk bonds to last June got to the equivalent of 5,000 gold.
Real bubble.
And the long treasury bond now, the bond future, it's up to the equivalent of 5,000 gold. And see, here's the thing that we try to get across, is that the Fed is crazy.
Mm-hmm.
Absolutely mad, demented fanatic. But it can't be unless it's got a speculator out there, and the speculator is speculating in stocks and high-grade bonds, not in gold and silver.
Mm-hmm. And
the Fed doesn't decide what's going to be the game. The public does. So here we are looking at 2015, and the advice we've had for the last 2 or 3 weeks has been to begin to accumulate some gold stocks.
Cautious.
And silver if you wish as well.
Cautious.
Cautiously, because you got a big problem out there, and that's crude oil.
Yeah.
Now, going back to early in 2014, and we had an interview with Maclean's magazine up here. It's the equivalent of, say, Newsweek, only a little more practical. And one of the writers there is pretty practical, too. So I just was in a good mood that day and said that crude was on a rally, maybe out to June or something like that. And but after that, that peak would probably be the cyclical, the high for the year, as well as a cyclical peak, and that it could head down. And what I was using and have used for decades is that when you're in a post-bubble contraction, the price of crude in gold terms can fall to 1/4 of the high that it was relative to gold. So, but somehow in the article it came out to fall to 1/4. So when crude was about 107, that comes out to about $30 or something. Well, publishing that in early last year, the journalist got some flack, but he stuck with the story. So and part of that story was that a major decline in crude would change the game in many things.
Mm-hmm.
So here we are now. Crude, when it started to fail in September, we looked at, number one, seasonal. Important lows of crude have happened in December and January.
Right.
Then we looked at the other thing, and we did a count on bear markets for crude, usually 6 to 7 months. January is the 7th month.
Mm-hmm.
So then the other way is to look at it, as I said, as deflated by the gold price, and it's down something like 53%, and if it's going to fall to 1/3, it's got further to go. Then previous bear markets, let's see my notes here, 85 to in November 85 to March 86. This is deflated by the producer price index. It fell 66%. That was when it fell from 31 to 10 in the nominal price.
Remember that?
In the 1990s.
That was when Reagan decontrolled the price of oil on the barrelhead in the U.S., and that just crashed the oil market like you couldn't believe. Yeah. I remember it well.
But also he had a side deal worked out with the Saudis that if crude was going to go down, don't support it because the Russians, the Soviet Empire, needed the money.
Mm-hmm.
So there's, of course, when everybody's talking now, the Saudis, But we put that into our story in the summer. And then you've got here, July 2008, that peak. That was actually the peak of the peak oil story.
Mm-hmm.
And on momentum on that one, man, we had our proprietary model, which was giving what we call upside exhaustion signals. So during June, it gave weekly upside exhaustion. So our conclusion was that you'd get a cyclical bear market for crude. And then the end of the month clicked in, and it gave a very rare upside exhaustion reading on the monthly, in which case wrote that it would be a secular bear market in crude. So then that one fell, deflated by the producer price index. That one fell 53%, pretty nasty. And that one fell 75% deflated.
$30 a barrel then again?
Yeah. Well, so here on the deflated PPI, it went from $142 to $36. So here we are. We've got. You didn't have the spectacular high for crude when it reached 107 in June this year. So you didn't have the dynamics that you had in 2008. But anyways, it all accumulated. The other argument we had was that where you saw the price of natural gas go from highs of around $12 or $13 down to a new low price regime. So then that was the other part of the story we had.
Right. Yeah.
Early in the year was that with and of course what it was in natural gas was fracking, and they're fracking the hell out of crude oil. So it had to go and do the same thing, down to a new low price regime. We didn't say that it would have the same percentage drop, but the concept was to a new and lower price regime, which we're getting. So at the moment, we think that crude, the bear market in crude will take a brief pause for a while. I don't know, a week or so, but on price, it has further to go. Remember that the crash from, November 85 to March 86 went into March. So let's put it this way, that when the bear market for crude started, a probable low would have been in January. But we're not calling the low yet, and because it has more to go in price. And it's also doing a great service, depriving the neo-Soviet empire being run by Putin of important monies. And it's also depriving the crazies in the Middle East of revenues that they need to forward their policies. So it's good there. But when it first started to come down, of course, the knee-jerk stuff was that, oh, this is great, it'll put more money in the hands of the consumers. But if you take a chart of crude oil prices back to 1913 and put on the vertical bars of recessions, most of the recessions have a weak crude oil price. As a matter of fact, throughout all of history, recessions have weak commodity prices. And the rule of thumb on that one, Kerry, is that good times are when you have rising prices and hard times are when you have falling prices.
Because you have demand and everybody's buying, so prices are being bid up. And in recessions, people are hoarding their resources and not buying, right?
Yeah. You mentioned the word hoarding, and that rang a bell. If you look back at the, last 300 years of markets when you have effectively had a stock market, there were enough companies being publicly traded in from about 1680 on that you could call it a stock market. Enough issues and enough traders. So you can say the stock market began in 1680, so it's been around for a long time. But the big pattern is you go through a period of rampant price rises in CPI, in commodities, in producer price, and in wages. And that blows out, like 1920 or like 1980. So then that is hoarding of tangible assets. And then some period later, you get the bubble in financial assets. So, and we've had a number of these since 2000. In 2000, the public was hoarding dot-com bubble stocks, and then they dishoarded them. And then in 2007, that peak, that had all the characteristics of a great financial bubble, like 1929, or the previous one was 1873.
Right.
Where once it was concluded, you'd go into what we call a post-bubble contraction, where the recoveries on the business cycle are weak. We've had that. And the recessions are, bothersome, serious.
Like 29, too.
So,
much
post-29.
Like
so, I don't know, say we're somewhere around 1937. You've had the first cyclical business expansion out of a classic crash, and the policymakers with their demented theories have this idea that if you provide enough credit, commodities will go up, the business cycle will recover, and all that sort of stuff. But
we know how
look at them, the amount of lolly they've put out the door since 2011.
Forget it.
And take a look at where copper's gone. Take a look at where crude oil's gone. Take a look at where gold and silver have gone. So that hookup isn't working.
Yeah, it never has. It never will. You know what Morgenthau, Secretary of the Treasury, said in 1939 about Roosevelt's policies. Never have we spent so much money, borrowed so much, gone into debt, and unemployment is the same as it was when Roosevelt came into office.
With such little result.
Right, exactly.
Well, you go back to even, the 1920 high in commodities was huge. And it was one of the worst crashes in commodities that followed 1921.
Yeah.
So then you got the new guys at the Fed, which is the new tool. So they spent the 1920s easy money conditions, hoping to keep commodities from falling further.
Yeah.
Instead, it was all going into the stock market. But you kind of look at it as a historian, and you know that in 1933 and 34 they came in with the Glass-Steagall Act to separate, commercial banking from investment banking. That made sense.
Yeah.
And they came in with the SEC,
Yep.
and the SEC was essentially charged with preventing another bubble. So if they had honest reporting and accounting and all that sort of stuff, you wouldn't have another bubble. So the main thing I'm getting across is that the policymakers then knew that the depression was caused by the boom.
Mm-hmm.
And it wasn't until the 1960s when you got all these economists came in with all their models and stuff, and they needed the Federal Reserve System to employ their models and their theories. So then they started to then hammer the guys that were at the Fed. They said the Fed was deliberately tight in the early 30s. Well, it wasn't. There's plenty of evidence. Like,
oh yeah,
the head of the New York Fed then in 1929, it was the big chapter, you know.
Mm-hmm.
And he stepped in and bought bonds out of the market.
Yeah.
And exceeded his authority by a factor of 6 times.
Mm-hmm.
Interest rate fell to 1%. And then in 1932, just at when the first recession was at its worst, Barron's had an editorialized that every anti-deflationary measure taken by the Fed is seen not to be working.
Yeah.
So all the guys in the street then knew that the Fed had really tried.
Mm-hmm.
So then they came in, they knew that it was best to prevent bubbles, so then you don't get crashes. And the SEC, as I said, no, also one of the one of the figures pushing for the SEC boasted that it would have put a cop at the corner of Wall and Broad Street.
Yeah.
So then you're in the bubble going up to 2007, and Bernie Madoff there, one of the biggest scams in history.
Yeah.
And a couple of whistleblowers went to the SEC, and they did not act on it. So if there's failure like you wouldn't believe, one, the SEC was to prevent a bubble, and it was also to correct malfeasance. Didn't do either.
No, we know that.
Not either.
So as far as 2015, precious metals recovering this year, or is it going into next year?
But in the deflationary manner, where the bullion price, it doesn't matter what it is in dollar terms, so long as the cost of mining gold is going down.
Mm-hmm.
And that is what's happening. We, of course, you know, the calculation of the U.S. CPI is somewhat suspect.
You think?
So then we created our own commodity index with gold not in it, because we don't consider gold as a commodity. Also, if you're going to want to deflate the price of gold, you don't want to have it above the divisor and below it. So now so we ended up with a commodity index that looks something like the Economist All Items. And it set at a very important low in June, and it kept recovering. And we consider that the real price of gold, is represented by gold outperforming commodities, is in a cyclical bull market. It was in a cyclical bear market from 2011 until June of last year. Mm-hmm. So this indicates improving operating margins. Just take a look at crude oil. Represents an important energy cost
input, yeah,
and
huge,
particularly on the petrol, on the side where you're going to make explosives.
Yeah.
So it's not just electrical energy; it's also the explosive side and everything else. So this is what really works in a post-bubble deflation, is that gold's price outperforms everything else. So this is Mother Nature's way, because at the same time, in the next few years, you're going to have another dreadful credit contraction going on, and the financial markets don't like a vacuum. So the real price of gold goes up. Miners produce more of it, and the gold goes into the credit markets, and it starts to reliquify the whole system when the usual instruments of credit are contracting and all of the invented new credit instruments are disappearing. So, hey, if these economists would just leave it alone, it's a wonderfully functioning system. So our view for this year is we would accumulate gold shares on weakness. For investors, we would have been avoiding low-grade bonds and instruments summer, and we've continued to ride the long treasuries, and they now are heading towards an ending action. So your prudent investor would be buying 3 to 4 year high-grade corporate bonds, and you'll avoid price adjustments during the credit risk, and price adjustments as interest rates change. So that makes an interesting portfolio: 3 to 4 year corporates and some gold shares. And I don't know, real estate. No, it's on its own bubble at the high end. People are paying immense prices for properties, and in Canada, of course, residential real estate is virtually at the moon and is probably vulnerable. So I guess we're just going to have to stay with our gold story.
Yeah, and whatever the nominal price does, the real price, meaning its purchasing power, is going way up. And if the advance in the real price of gold on each of the past 5 depression, Great Depression, has been consistent. It goes up, and the gold mining becomes the premier industry because everything else is depressed because of weak pricing power and everything else. So in a post-bubble deflation, gold it becomes the premier industry, and we're looking forward to it. Yeah, and everyone got a head fake this time, though, because of the bear market for the past 3 years that it was in for what now are obvious reasons. Weren't so obvious when they were happening, for sure.
No.
Yeah, interesting. So thanks for giving us that explanation there. And stock market really getting to its high point, maximum valuation.
We look at the big New York Stock Exchange composite, the NYA. Mm-hmm. And it looks like it's doing a big rounding top like it did in 2007. Very similar, even on the moving averages and stuff like that. And then in looking at the European stock market, the stocks, it is doing that as well. And it also did a very good rounding top in 2000. And so in the case of the European stock market, the stocks, you've got three recent examples of this pattern, 2 previous, 2000, 2007, and now it's working on it here now. So got oversold last week. The first week of trading in the year scared the hell out of everybody. And I think this is testing the highs. And somewhere in the next 3 or 4 months, the senior indexes in New York and the stocks will probably break down completely and head into the next bear market.
Oh, hey, and one final discussion: euro. Is it? Dead?
Yeah. Let's not overlook the U.S. dollar.
Yeah.
The rule of thumb on the senior currency in a post-bubble environment is that it becomes chronically strong relative to most commodities and most currencies for most of the time. And it may be getting a little overdone here now, but we've got a big model, a pattern that it's in, and this can go a long ways yet. It'll be relieved from time to time because you've got the business cycle to deal with. But now we're looking at, let's look over the conclusion of this business cycle, in which case we're really back into another deflationary squeeze, in which case the dollar is going to go even higher. One of the mechanisms, let's also say, Kerry, that the Federal Reserve, of course, its theories and its whole culture is to depreciate the dollar. But It's not happening.
They can't do it fast enough.
In a bubble, in a financial bubble, although the stock market gets most of the ink, there's also even bigger speculation in bond market. And most of the new issues are done out of the financial capital, and that's New York. And then on these issues, they're due interest payments, and principal are due and payable into New York in U.S. dollars. Mm-hmm. So now London is a big market as well. But let's say 60% of the bonds that were floated were done in New York. So that just the debt service on that represents a huge short position.
Yeah, effectively, yeah.
And this is where, going back to Gresham when he was advisor to the British monarchy with Elizabeth in the 1550s. This is a lot of the letters from Antwerp, was then the financial capital of the world. And Gresham wrote, of course, to Burleigh, who was head of the Exchequer, explaining the problems of servicing debt you owed into then Antwerp in guilder from a weak sterling. Mm-hmm. And this is the classic problem now. Euro, they're weak. Anybody in Euro is owing money into the U.S. is in deep doo-doo. And so it was even working back in the 1500s.
Yeah.
Where if you've borrowed money in a hard currency and have to pay back from a weak to a hard currency, you got a problem. So this is so that no matter how hard the Fed will try to depreciate the U.S. dollar, it won't go down because it's still the senior currency. The idea of China becoming the senior currency is that's just not on the books. It ain't going to happen because they're still run by a bunch of communists. So
kleptocrats, right?
Yeah.
Not that we're not, but it's a different kind of kleptocracy.
Yeah.
A less friendly face on that kleptocracy. Yeah, at this point. But the future, who knows? But yeah, I agree with you. It turned out to be a big short. I mean, they didn't really know they were necessarily shorting the currency when they were doing it. It wasn't a conscious decision to short the currency. But it was effectively, just it's better when you're getting paid in that currency, when your income comes in that currency, because then, you're okay. Yeah. Like the banks, right? Yeah. The banks can short the currency because, hey, their income is derived in the currency, and the citizens of that country can. Or citizens of other countries like Panama that have dollarized can do it. But when other countries outside do it and then they wind up getting surprised on the upside, that's the mother of all short squeezes, right?
It is, yeah. And we're looking at it here in Canada, 84-cent dollar. You buy stuff in the States and you're giving up, it's costing you an extra 15%.
Yeah.
And then it's even worse if you're in other currencies. So my suggestion to the government of Canada is get rid of the Bank of Canada and go to a currency board and keep it pegged relative to the U.S. So.
Yeah, for now.
But they ain't going to do that.
No, not. Anyway, Bob, hey, it's been really enlightening, and things are starting to make a little bit of sense. And I guess we'll just keep the tulips for a little decorative attire around the home. Hey, best way to find you on the internet?
It's institutionaladvisors.com, or nowadays with the internet being so prevailing, you can just type in my name, Bob Hoye, Bobhoye in the Google, and bang, all the stories come up, and you can get into the website, put you on a no-cost trial for a number of weeks, and then if you want to stay on, that's great. We welcome you, and if not, nice talking. Okay.
All right. Thanks.
Kerry, all the best.
Hey, thanks. Bye.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.